Hello, good morning everyone. Hope you are doing good this morning. Today we were supposed to be doing our revision on our assignment 3 as advanced taxation is concerned. So here is the question in the screen and this is what I think everyone did. So to begin, this is the question. Maendeleo Limited is a manufacturing company operating through a number of branches in Kenya. So the following information relates to Maendeleo Limited's operation for the year ending 31st December. So these are the information. We have turnovers and they are in thousands. As you can see, here is thousand, here is thousand. Turnovers we have 19,480. Goods cost of goods sold we have 5,620. We have gross profit 13,860. Foreign exchange gain 148. We have insurance recovery for stolen motor vehicle 968. We have proceeds from sales of factory extension 469. That totaling to amount of 40,545. Then we have expenses, which was there in the equation. So here we have direct emoluments and staff costs 16,890. Pension contribution for staff we have 4,200. We have staff recruitment cost 1,148. Then we have purchase of furniture. As you can see, purchase of furniture we have here for a 420. Penalty on overdue VAT. This is just the value added tag 168, 164. We have impairments, loss of factory extension 150. Mortgages interest 364. We have goodwill written off 162. We have loan interest 1,286. Depreciation 908. Then we have general office expenses. So the total expenses are summing up to 27,040 or and 40. So after deduction, you will be getting a profit of 13,505, and that is what our question entails. We have additional information. Additional information is talking about details of property, plant, and equipment scheduled reflected the following details for the assets that existed before the year ending 31st December 2020. So we have asset written down value, we have additions at cost, depreciation, then disposal proceeds. And remember, we are in 2020. So computers, we have that. Water pump, we have that. So here is the written down value. For computers, it is here. Furniture, it is here. Conveyor belt, we don't have any written value for it. Delivery van, cash registers, printers, tractors, motor vehicles or motorcycles, which packing machine. Then we have non-processing machineries. So let us just highlight that to make our work easier. So there are some additional information here, which is down here. We are being told a perimeter wall was constructed at a cost of 960,000. That one was the cost of constructing a perimeter wall. So during the year ending 31st December 2020, used from 1st March 2020, and you can see that a go down and a drainage system were constructed at a cost of, that is drainage and go down was constructed at a cost of 2,860,000 and 1,780,000 respectively, put into use on 1st April 2020. So here a go down was constructed at amount of this here, which is 2,860,000. Then a drainage system was constructed at 1,780,000. Then we are being told the company constructed a borehole. We also have a borehole in an additional information, which a borehole at a cost of 1,000 or 1,500,000 during the year, which is put into use from 1st July 2020. Required capital allowance due to Maendeleo Limited for the year ending 31st December 2020, and you can see it is what awarded 12 mark. So these are my solution that I came up with for this assignment, and you wanted us to revise this morning. So to begin, no, the font is not that clear. Let me light it using another color that is very clear. So here we are. So to begin, this is in investment allowances. So we have investment deduction, we have capital deductions, we have industrial building deductions, and we have many things to do with the qualifying and qualifying. These are rates. We have residue, we have wear and tear allowances. So we are going to start with our first one, which is the allowances. So the first allowance we are supposed to be doing is investment allowances, based as the question is concerned. And I hope everyone has the equation, they can follow up. So in investment deduction, we have assets. So you just create a table with 5 columns and the rows based on the assets you have. So we have water pump. Water pump qualifying cost is 280,000, and if you come up, I will not be coming up from this time. I'll just show you what to do, then you will continue. We have water pump. Water pump is in additional information. We have water pump. You can see water pump here is 280,000. That is an investment allowance. So you will be putting it as investment allowance. If you continue and look at conveyor belt, you will find that conveyor belt is 960,000, and you will be confirming for me. We have conveyor belt 960,000. So you continue on that. With that, you just put the assets down. You are supposed to which investment is supposed to be given, then you put them down. Then we have packing machine 860. You just come up a bit, then you look at the packing machine. Okay. Packing machine is just below this. We have 860. It is here. Can you see this? 860,000. So you just put it down and give it at 860,000. Perimeter wall will be the same. If you go to that information, you will find that the perimeter wall is 960,000. Then draining system. This is where we are having respectively. So if you come here on the top, you will find perimeter wall 960,000. Perimeter wall is in additional information. A perimeter wall was constructed at a cost of 960,000 during the year ending 31st December 2020, used from 1st of March 2020. And you can see that. Then you will find this additional information is one of the investment allowances, because it is a construction. It was being constructed. Drainage system of 1,780,000. If you come down to additional information, you can come here. A go down and a drainage system were constructed at a cost of 2,860,000 and 1,780,000 respectively, meaning this 2,860,000 is for a go down and a drainage is 1,780,000. So the rate for charging all this is 50%. So if you start calculating, you come 50% of this, it is like getting a half of this, you'll be getting 140,000. The residue, after getting 50% rate, what is it that is remaining? If you take 50% of 280, you'll be getting 140. And it applies to all other investment deduction. You will find that residue is what is remaining after deduction. So if you take 280,000, you subtract it, or you take 140,000, you subtract it from 280,000, you will be remaining with 140,000, and that applies to all the same. So the total investment reduction is 2 million. If you sum all this investment reduction is 2,420,000, and that is all to do with investment deduction or investment allowances. Let's move to the next allowances you are supposed to be looking at. We have industrial building deduction or allowances. So here you come and create column based on what you need. We have item, qualifying cost, residue, qualifying amount, rate. Then we have investment building deduction. I just shorten it as IBD, then residue. So a go down is a investment building deduction. We have a go down, and if you just come up here, you will find that a go down when was built or was constructed at. So you can see in Roman C, a go down and drainage system were constructed at a cost of 2,860,000, and I think that is there. What is there in the system? A go down is just a building deduction in short. So if you come to building deduction, you are supposed to be writing the qualifying cost value. So we have 2,860,000. Then the drainage. Drainage is one of the most building deductions. So we have either go down, drainage, we have boreholes, we have perimeter wall. Perimeter wall, I think everyone by now they know what perimeter wall is. Just a wall just surrounding a building. That is a perimeter wall, and it can either be that tall or that short. It's based on how people build. So these are the information. Let me confirm for you if a borehole is 1 million, the qualifying cost is 1,500,000. You just come up to your information here, then we will look at a borehole. Borehole was constructed, perimeter wall was constructed. You can see this. I go down this. Then the company constructed a borehole at a cost of 1 million during the year. It is 1,500,000 during the year which was put into use in July 2020. So under industrial building deduction, we have the qualifying cost, residue, qualifying amount, rate, and that is all. But remember, we have months on which these items was put in place, and it was being written like a go down. A go down, we are being told here, it was put into use. Let me check on go down. A go down and a drainage system were constructed at a cost of 2 million, but we are instead of a go down of 2,860,000 respectively, and put into use on 1st April 2020. So from 1st April, you start counting from 1st April. For April, June, July, August, September, October, November, December. It is summing up to 9 months. So you are going to take 9 over 12 times this amount, which is the go down amount, which is 2,860,000. And if you come down here, I had did everything and we have all the information you can see. So we are going to have this. So if you take 9 over 12 times that amount, you are supposed to be getting 2,145,000, and that is the qualifying amount based on the day the item was put into use. Same to drainage, 9 months over 12. You check 9 over 12 times, you know I here has 12 months, so you just take 9 over 12 times 890,000. You are going to get 667,500. So for perimeter wall, you do the same, 10 over 12, but you find that perimeter wall was put into use in, let us check the perimeter wall. A perimeter wall was constructed at a cost of 960,000 during the year ending 31st December 2020, used from 1st of March. So if you leave that, if you start counting from March, you will find that you are going to get exactly 10 months. You have March, April, May, June, July, August, September, October, November, December. 10. And that is why we are taking 10 over 12 times this amount, which is, this is it, it is here. You take it, which is perimeter wall 960,000, that is the qualifying amount. Then the residue is 480,000, because if you take half of it, that is the residue. Then you take 10 over 12 times 480,000. You are going to get 400,000, and that is all to do with industrial building deduction. Borehole, the same, you just follow the same procedure. We take 6 over 12, meaning it was put in place from, I think, July. Borehole, let me check borehole just for confirmation reason, so that we avoid so many errors. So boreholes, in additional information, we were told a company constructed a borehole at a cost of 1.5 million during the year, which was put in place from 1st July. So if you count it, or if you start counting from July, you will exactly, that is when the borehole was put into use, from 1st July. So if you start counting from 1st July, you will find that you have 6 months, and that is why in our solution we are going to take 6 as the qualifying amount. 6 over 12 times 1.5 million, which we are going to get 750,000. And remember, it is just like taking a half of this, because 6 over 12 is half. Yeah. So at what rate do we charge each of the following industrial building deduction? We find that a go down will always be the rate of being charged is always 10%. Drainage, perimeter wall, borehole, those are always being charged at 25%. So for qualifying amount, if you take the qualifying amount times 10%, which is here, this 2,145,000, you times 10%, you just take 10 over 100 times that 2.14 million, you will be getting this, and that is a must. You will be repeating the same. You take 25% of 667,500, you will be getting 166,875. So you can just confirm with using your calculators. Then you have 10 over 12 times 480,000, you times 40,000, you will be getting 400,000. Then you take that your 400,000 times 25%, you are going to get 100,000. So residue amount, how should we get the residue amount? we have after charging industrial building deduction, which is in this column. So we'll find the industrial building deduction will sum up to 668. It is here, just below here, 668,875. That is the amount of industrial building deduction which we will be using down when we are giving our investment allowances. So that is all to do with industrial building allowances. The next thing we're supposed to be looking under this place is wear and tear allowances. So under wear and tear allowances, just go down and it is like summarizing what we were doing. So what class do we have in wear and tear allowances? We know that items or assets as classes. Like here we have a class, you just create the row and column the way you want them to appear, then you have your items. Then we have working down value brought down on 1st January, which we have nothing. So for computers, furniture, you just come back on the table, come here, we have computers, you can see we have 525,000, we have water pump 280, furniture 360. Those are some of the things you're supposed to be bringing down. Like here we have in capital allowances, we have computers 520, and it is always given a class of class 2. You can see each and every asset or each and every item has its class. So class 1 always have 25% rate, class 2 25% rate, class 3 we have 25% rate. So it is only class 4 that is always charged at a rate of 10%. Then class 5 we have 25%. So working down value brought down on 1st January, you will find that from computers we have 525,000, furniture here is a class 4 360, or it falls under the right language to use, it falls under class 4 for furniture. Delivery van 360,000, we have no delivery van is 2,560,000. So we have car register, printer, tractors, motor vehicle. So all these are working down value brought down on January, and they are just in our information there. Like motorcycles, you will just find it up here. For confirmation, we have motorcycle, it is here. You can see this here. You just bring it down as wear and tear allowances, things that get into use. So you can come and see motor vehicle, the 300 we have none. Processing machine as 960,000. So this is the method of getting wear and tear allowances. After writing working down value brought down on 1st January 2020, and that was our year we were working with, we add additional or additions in the year. We have computer additions was 345,400. So you just come up, you look at computers. Can you see computers? Additions is here in this row. This is the working down value which I was talking about. Everything this asset is here. So additions, we have 345 for computer, water pump 280, furniture 140, conveyor belt 690, and that continues. So it is only upon you to know how to do wear and tear allowances. So under additions, you just come computers 25% because it falls in group 2 or class 2 items. So you just put 345 400. You come furniture the same. So furniture, just come for confirmation. We have furniture 360 140. So this is the working down value. Then this is the additions. We have 140,000 and depreciation 82,000. So if you come down in wear and tear allowances, we were looking at addition of furniture. You can see this, and the summing up to 560,000. If you just take 140 plus 420, it should be 560. Delivery van the same, tractor the same. So we less disposals. after getting addition or adding from the working down value, you add additions in the year. So from that, you're supposed to be getting all this information from the table provided. So we have less disposal in the year. Disposal in the year is here. For those who cannot see, this is the right time to see them. Disposal proceeds in the year. So you have them here. So computers 250, we have delivery van 620. So you come down here on disposals, just come down still. We have computers, delivery van, motorcycle, the way they follow each other. So you are going to less them. That is 250,000, 620,000, and 968,000. Those who are doing their assignment are not putting this in bracket. Bracket means it is supposed to be deducted. And here you find out as students just write it very well, less year or disposal in the year. And here you just leave it 250,000. How will you get the correct answer here when here you are just going to write 50? It means for your case you are adding 250,000 instead of lessing it from our working down value and our disposals. So for that case, you're supposed to be lessing all that you had. For this case, there's nothing to less. For computers, you just had all this information. You will get 4,300,000, and that is if you sum up all this information, you will be getting that. You repeat the same to the second column, third column, fourth column, as still that continues. So you're supposed to be getting these amounts under here. So we have wear and tear and netbook value. So that is the stage where you are supposed to now be lessing wear and tear allowances. So 10% for you to get wear and tear allowances for this class 1 or group 1 assets, we have 25%. So you're supposed to be getting 25% of this amount. Which you're supposed to be lessing it from all the working down value. We have the disposals and we have the other tier and wear allowances which you are adding, the additions. So for that case, you're supposed to take 25% of that, and if you have a calculator, just confirm 4,300, 4,300,000 times 25%, you will be getting 1,075,000. And you continue with all this from that, you take that. It is only here you are supposed to be getting 10%. And for that case, a good example for you to know how we are getting wear and tear allowances, you take 1,880,000. So if you take 10% in this column, it is class 4. You can see 10% here. So if you take 10% of that amount, or the total amount, which is 1,880,000, we are supposed to be getting 188,000. And the same you repeat here, you take 25% of that, you get this. So the net book value is you take the total sum of what working down value plus additions less disposals, then less wear and tear allowances. If you do that, you are going to come up with, or you are going to get a total of, for this class 1, you're supposed to get, take this minus this, you'll be getting 3,225,000. Take this and this, you're supposed to get 1,065,300. You do the same for illustration purposes. So the total, what we are supposed to be doing at last is how do we get total capital allowances. For you to get total capital allowances, let me just highlight this. That is okay. So for you to get total capital allowances, we started with investment deduction, which is being shortened as ID. We have industrial deduction, then we have wear and tear deduction. So we have class 1, class 2, class 3, and we will define that. So for wear and tear allowances, let's start with this three. Wear and tear allowances, because it is just above this. So wear and tear allowances deduction, WTD, we have class 1 wear and tear allowances, these three. You can see wear and tear allowances 1 million, followed by 355 100, followed by 358 500. It is just here, same to that, same to that. Those are for you to get total capital allowances. So investment deduction and industrial building deduction, you will find them above this place. So total 2,420,668.87 if you are using decimal, but remember these are in shillings. So if you just come above, you'll find that the total industrial building deduction is here, this bolt. Then if you come up, investment deduction is 2 million. So for you to get the total capital allowance, you just add them, and we are going to have your total capital allowance as 5,325,975. Remember, these are total capital allowances. So how do we generate the taxable income for Maendeleo Limited? And that one was required in the assignment. For those who reach here well and good, you are not going to get the marks for this. But for those who scored good with you, keep it up. So for you to get taxable income for Maendeleo Limited, you are supposed to, that is taxable income. So for a taxable income, you are supposed to always start with the net profit. All this I wrote here are just statements. At net profit as per the trading profit and loss account, you can just write net profit. So the net profit, we have 13,505,000. And if you come up here, you're supposed to be getting your net profit. It is here. So your net profit is this. Can you see this? I told you it is in this row, in this column we have 1,000. So this is 13,505,000, and that is our net profit. So you just come here and give your net profit, then you less other deductions which are required to be deducted for you to get your taxable income amount. So you come here, you give a title, Maendeleo, taxable income for Maendeleo Limited for the year ended 35. These are marks. You can get 1 mark for this if you don't know anything about taxable income. So you're supposed to come here, give your heading that, then you write total capital allowances, then you write net profit. I have showed you where it is. Add disallowable. Disallowable, these are items that cannot be allowed, or they are tax exempted. So disallowable, we have depreciation 908,000, goodwill written off 162, impairment loss factory extension 150,000, penalty on overdue VAT 164,000, purchases on furniture 420, and you add them all. If you add all these, you are supposed to be getting this total sum 908, 162, 150, 164. You're supposed to be getting all this. I know somebody can ask me, how do we get depreciation? All this information you have in your question. So like depreciation, there is no need even of asking how we get depreciation, and the depreciation is in this column. Even if you are blind, guys, just work smart, you will score some mark. So under depreciation, you will be looking depreciation like computers 131, 520, and you just check them like that up to the last. We have motorcycle 68,000. Then you come down here when you are giving your deductions or disallowable expenses, we have depreciation. And remember, not all items above there disallowable expenses. There are allowable expenses disallowable expenses. And for now, you are supposed to be knowing what disallowable expenses are and what allowable expenses are. So depreciation is a disallowable expense. You go to your table, you know depreciation is disallowable. You check depreciation at which amount, 9 or 8. Goodwill written off, you do the same. Impairments loss on factory extension, then you have penalties of VAT, then you have purchases of furniture, then adjusted net profit. Adjusted net profit always net profit minus disallowable expenses. If you have any allowable expenses, you will also be deducting allowable expenses, and that is always the procedure for doing taxable income for capital allowances. So under this we have adjustment net profit, not taxable income. Remember, for taxable income, for you to get taxable income, you just take net profit less or add disallowable expenses less allowable expenses, then less capital allowances. You will be having your taxable income as required. So for this case, we have our net profit 13,505, disallowable expenses, you add all that sum up to 1.804 million, then we have adjusted net profit. So if you take net profit minus disallowable, you are supposed to be getting adjusted net profit, which is here. And what will you less here? Capital allowances. So capital allowances is 5 million, which is here. It is just above this our information. So you less your capital allowance is 5,327,975. Then you are going to be having your taxable income as 9,981,025. For those who got that, congratulations. And that is what we were supposed to be looking today, and what you wanted me to do as the revision of assignment 3 is concerned. Thank you all for your time. Thank you all for listening. Hope we will meet in our next session. Thank you, good guys, and may God bless you as you have a good day. Thank you.